everyone, welcome to Betty Academy. Our work is to make your school life easier and by understanding different concepts. And today we are going to learn about accounting equation. Accounting equation. If this is the kind of video that you'd like to watch, to see, kindly subscribe, comment down below, like and share. So today we are going to learn about accounting equation. When you look at accounting is based on the principle of two-sided. In order to carry out business activities, the company needs funds. These funds may be given to the company by someone. The funds owned by the company are called assets, and part of these assets is provided by the owner, and this one forms the total amount of funds contributed by the owner is called owner's equity or capital. If the owner is the only one who contributed, then the equation will be assets is equals to owner's equity, right? However, the assets may be contributed by someone else who is not the owner. The debt of the enterprise for these assets is called liabilities. Therefore, now the equation will take the following form. Assets is equals to liabilities plus owner's equity. So it means that it will take the form of, if it's the owner who only contributed that amount towards starting the business, the equation will be assets is equals to owner's equity. But if the funds was contributed by another person, that is the owner, together with someone else, it will be assets is equals to liabilities plus owner's equity. And in this case, from our previous lesson, we learned what assets are, and assets, we agreed assets is the properties that is owned by the owner, that is the owner of the business. But from this, whatever he contributed, it forms the owner's equity. But the liabilities, it's what the enterprise, or rather the entity, got from someone else. So we should be able to understand this one well from an illustration. Let's look at this illustration. From the illustration, let's go through it together. So we have Johnston started a new business during the month of June 2021. He carried out the following transactions. We have the first transaction was Johnston commenced business with 20 million. So Johnston started that business with 20 million and land worth 5 million. So how do you record that? So it's Johnston who commenced that business with 20 million and land 5 million. So we have all those transactions all the way to X. So when you look at this particular suggestion, this is the solution that we have. We are going to use. Hope we should be able to see that. So we have the first one. We have the first transaction, which is this one. He started business with cash of 20 million and land 5 million. So you have those ones, cash and land, they all belonged to the owner. So these ones are assets and asset. And on the far end, this particular asset, which is 20 million plus the 5 million, is what you get as owner's equity, which totals to 25 million. So you see, our accounting equation is complete. It is complete at that particular point. So the other thing that you need to get is, let's look at the second transaction. The second transaction we have Johnston, the second one, bought merchandising for cash worth 8 million. The total was 8 million. So when you look at that, of course, From the first transaction, let's look from this illustration. He started business with 20 million and he had 5 million, and we at that particular point he had the owner's equity was 25 million. So this one is 25 million, and the balance at the end when he was closing the business by the end of the day rather, we have 20 million, 5 million and 25 million. So it balances, right? So when you look at the second transaction, from what he had, he bought merchandise for cash. So our cash decreases by 8 million, right? Our cash decreases by 8 million. So again, also our owner's equity will decrease by 8 million. So by the end of the day, you'll have a balance of our cash will reduce from 20 million, you minus 8, you get 12 million. Our land has not been touched. And again, the last bit, which is 25 minus 8, you'll get your 17 million. Again, at this point, our account still balances. Let's go to the third transaction. The third transaction, we have cash. We have cash sales worth 2,500,000. That was the cash. The cash is 2,500,000 cash sales. So Johnston made some sales. So that one is an income. So what happened is that when you look at our cash column, this one is our cash column, it increased by 2,500,000. And again also 2,500,000. And again, our owner's equity, it will also have the same effect. It will increase by 2,500,000. So what will be our balance by the end of that transaction? We'll have the 12 million that we had at the start plus 2.5, you get 14,500,000. Our land still remains the same, and we have this one, our owner's equity, it was 17 million, but now from the 17 million, you add 2.5 million, you'll get 19,500,000. So let's go to the fourth transaction. From the fourth transaction, let's read together. We have Johnston bought goods on credit from Mary worth 5 million. So Johnston bought goods on credit. So when you look at that, he bought goods on credit. That is transaction number 4. So from the transaction number 4, I hope you are able to see that. Transaction number 4, we have he bought goods worth it was worth 5 million. So let's go all the way. We'll have that one is we bought goods right. Let's continue. We were on point number 4. We look at it this way. We have Johnston bought goods on credit from Mary worth 5 million. So when you look at our solution, we have this one is solution 4 under accounts payable, because he bought on credit. So Johnston owes 5 million to Mary. So under accounting, that one will fall under accounts payable, and we have the 5 million here. Yeah, so that one is on credit, and the moment it's on credit, it is not touching on our cash. Look at it. There is no transaction under our cash, our land and everything else. We go to accounts payable 5 million, and it also decreases our owner's equity from 19.5. You minus the 5 million, you'll have your 14.5 million. Yeah, and the balances drops to 5 million. You have your 5 million under land and cash. Then we go to the fifth transaction. The fifth transaction, we have Johnston made sales on account to Paul worth what? 1.2 million. So it's sales on account. So this is a term under accounting. The moment you hear there is some sales that was made on account, it means it was on credit. That one, it was not on cash. So when you go to 5, let's look at our 5. This one is our 5 now, our 5. So he made what? Paul owes us an amount owing to 1.2 million. So he owes Johnston now. We have under accounts receivable, we have 1.2 million, and the 1.2 million here, it increases our Johnston's owners equity from 14.5 million. You add 1.2 million, you get that, you get this particular figure. This one plus this, you get this. Then let's go to number 6 now. Number 6, let's look at the effect. We have Johnston purchased furniture of the value of 5 million. We are on 0.5. This particular figure, he purchased it's 5 million by cash. So what will be the effect? So we go to point number 6. So we have its purchase of furniture. Our cash will decrease by 5 million. We have 5 million by cash. That one will it will decrease by that particular amount. And also under the furniture, you'll still have the same figure there. Yeah, right. So that one cancels each other. Again, when you look at the effect under cash and furniture, all these ones, they are all one particular side. So the moment one increases, the other one also decreases. So it will have zero effect on the owner's equity. Let's go to point number 7. Number 7, we have received cash from Paul, 1 million. Number 7, we have, you see, the 1 million. We have the 1 million here, received cash amounting to 1 million. This is the 1 million. And also under our accounts receivable, because we were to receive an amount of 1.2 million from Paul. When you look at that transaction, it was on transaction number 5. Look at transaction number 5. We have sales on account to Paul amounting to 1.2 million. But when you go to point number 7, Johnson received cash from Paul, 1 million. So this particular debt from Paul, it has reduced by 1 million. So when you look at the transaction, here, you have the effect of 1 million here, and the accounts receivable 1 million. So this one, being that accounts receivable and cash assets, it means when our cash increases, our account receivable decreases. So we have zero effects on the owner's equity. Let's go to point number 8. When you go to number 8, we have this is number 8. Return defective furniture of worth 150,000. Yeah, that is it. We returned defective furniture. So it means when you go to that particular number, it's number 8 transaction. This is the transaction number 8. So the moment you return this furniture, remember Johnson had bought that furniture. Yeah, when you look at this particular, it is under transaction number 6. He bought furniture worth 500,000. So here we are reducing the 150,000, because the moment that furniture is defective, you have to return to the owner. So that is 150,000, and you will get cash. This cash, it will increase. That's why you see this one, it's a positive figure under cash column. And here you have the same amount of figure, 150,000, decreasing under furniture column. So by the end of the day, 150,000 and this one is a negative figure, it cancels out. Then what will be the balance? Here are the balances. This one, you add this, you get this. You drop this 5 million, the 200,000 balance. This one you get 355 million, and here 15,700,000 on the far end. This particular figure. So that's the effect. We go to point number 9. Number 9, we have paid. We have paid wages 1 million, rent 200,000, and electricity bill payable 150,000. right? So here they are the payments that are being done. So when you look at those payments, we have paid wages 1 million. So that one is under cash. So paid 1 million, then rent 200,000. Yeah, so when you look at this one, we have paid wages 1 million, rent 200, no, this is 100,000, and rent 200,000. But the electricity bill, this one is payable, meaning it is yet to be paid, 150,000. So the expenses that we pay, that Johnson paid on cash, we have 100,000 plus 200,000, you get 300,000, and that's why you have your 300,000 here. It is decreasing from cash. Then from this other side, we have the bill payable. The bill payable, yeah, right? This one is all payables there. That's why we have a column of accounts payable. We have this particular column. I hope you are able to see. This is the accounts payable column. You see, this is the electricity bill payable amounting to 150,000. So you drop these figures, this minus this, you get 14,850,000. You have your 5,200,000, 350,000. This one plus this, you get 5,150,000, and here you have 15,250,000. So what will be the net effect? Because at all times there's this accounting equation, and it applies in all accounting transaction. Any transaction that occurs in a business, the moment you record, it must balance out, and it means it has the both sides of the accounting equation. So how do you arrive at that? Let's look at the net effect. The net effect we have, you see the red one here. All the way we have cash, land, accounts receivable, and furniture. All these ones are assets. They are assets. And we said from the accounting equation, we have assets is equals to liabilities plus owner's equity. So under assets column, what do we have? We have all these ones. The moment you get the total, it adds up to 20,400,000. And on the other side, we have the liabilities. The liability we have 5,150,000 plus 15,250,000. You get what? 20,400,000. And by the end of the day, you'll have assets is equals to from the accounting equation, you have assets is equals to liabilities plus owner's equity. If it does not balance out, or rather if it does not, both sides of the equation does not balance, it means there is an error. So that's the end of our video. Until next time, bye.